Welcome to Doodles, the channel where we break down financial trends and help you make smarter money moves. I'm Clement Cyril, and today, we're diving into a topic that affects everyone. Whether you're taking out a loan, using credit cards, or just trying to keep up with rising costs. Yep, we're talking about inflation and how it impacts credit rates. We're talking about your money here, and understanding how these things work can save you thousands of dollars in the long run. Let's get started. Okay, so let's break down this whole inflation thing. In the simplest terms, inflation is like that friend who always eats more than their share at dinner. It makes everything else smaller. Except instead of pizza slices, we're talking about the value of your money. See, when prices go up over time, your hard-earned cash doesn't buy as much. That $10 you used to spend on a week's worth of avocados, now it barely gets you one. Sometimes it's increased demand. Everyone suddenly wants a Tesla, and the price shoots up. Other times it's supply chain issues. Remember the great toilet paper shortage of 2020? Whatever the cause, central banks like the Federal Reserve here in the US keep a close eye on inflation. Alright, so we know inflation makes your money less powerful, but how does that tie into interest rates? Well, think of interest rates like the price you pay to borrow money. When inflation is high, lenders get nervous. They want to make sure that the money they're lending out today will still be worth something tomorrow. So what do? They raise interest rates. It's their way of offsetting the risk that inflation will eat away at the value of their returns. Let's say you want to buy a car, and you're going to take out a $30,000 loan for 5 years. If inflation pushes rates up to 6%, that same loan will cost you almost $5,000 in interest. That's a huge difference for basically the same car. Chapter 3. How this affects you, from credit cards to mortgages. I know what you're thinking, this inflation and interest rate thing sounds like bad news. And you know what? It can be, especially if you're not prepared. First up, credit card debt. If you're carrying a balance on your credit cards, those interest rates are going to keep climbing, making it even harder to pay down what you owe. Next, mortgages. If you've already locked in a fixed-rate mortgage, you're good. But if you're looking to buy a home or refinance with an adjustable rate mortgage, be prepared for higher monthly payments as interest rates rise. Higher interest rates mean higher borrowing costs for businesses, which can stifle growth and even lead to higher prices for consumers. The key takeaway here is this: don't bury your head in the sand. The more you understand how these forces work, the better equipped you'll be to navigate them. Chapter 4. Beating inflation, practical tips to manage your credit. Alright, so we've covered the bad news, but don't worry, I'm not going to leave you hanging. Let's talk about what you can do to protect your finances in this environment. First and foremost, tackle that high-interest debt like it's your job. Credit card debt is the worst offender here, so make a plan to pay it down as quickly as possible. Look into balance transfer cards with low introductory rates, or consider a debt consolidation loan to simplify your payments. If you have adjustable rate loans, explore refinancing to a fixed rate. Boost your credit score. The better your credit score, the better interest rates you'll qualify for. Outrow, stay informed, stay ahead. Inflation is a challenge, but it doesn't have to derail your finances. By staying informed and taking proactive steps, you can navigate rising credit rates wisely. If you enjoyed this episode, don't forget to subscribe and share it with a friend who needs to hear this. Until next time, keep making smart money moves.